Hey guys, what's up? It's Jared from Click Capital and welcome to our daily technical analysis show where we'll be going over 80 major markets and using our custom indicators you see on the screen, providing some price projections on where things could go next. And be sure to stay tuned in to the end where I'll be providing my final analysis on the SPY and how I am personally positioned. And what an interesting day it was. If you watched our daily show yesterday, you would realize that I was 60% net short going into the day. So I've had a good day. I hope you have as well. Things have changed a little bit. We have the SP off 1.5%. Q's actually held up the best. The big story today was the 10-year note, which we'll get to soon. VIX popped up. We're now above 20 and holding from this support zone. And we've had breadth roll over the amount of stocks above the 20-day average now 81% and still elevated. What was interesting, put-call ratio rose, and normally this is a contrarian indicator. However, they sometimes can be right. For example, the start of the COVID bear market, a lot of people were buying puts that did turn out to be right. One thing that was interesting today, and because of we had the 10-year off so much, normally growth names like lower interest rates, so we did have cyclicals outperform defensives, as you can see on the spread chart here. NASDAQ was higher than SP, small caps flat, growth did outperform value today with those lower rates. However, look at the yield curve, down 7.4%. That is a big drop. That is the market saying it expects more of a recession to come. The market is definitely more worried than what the Fed is. The market's pricing in a higher chance of a recession and a higher chance of the Fed actually lowering rates later this year. You can see the 2-year yield was off 3%. We're down to 408 and holding this support zone. The 10-year was actually off 5% and a big bearish Marubozu down here below the support zone. I was thinking this was going to hold, and if it went through, it would be bullish for equities because they would like lower rates. But however, what the market is saying is it's more worried about the recession as opposed to loving lower rates. So the lower rates is because it's seen softer economic activity, and the big report we had out today, which kicked things off downwards, was retail sales. Retail sales were down the most in over a year, and actually revised November retail sales down 1.1%. So I think the higher rates is starting to have a material effect on the consumers. They are pulling back their consumer spending, and that is really not good for the economy. You've also got things like analysts revising EPS, earnings per share, downward. And for the first time, we're going to have a lower earnings quarter in this cycle. And other things like Microsoft laying off 10,000 workers, that's not really a sign we're in bull mode. So things are looking downward for equities. And to support that thesis, we can see Treasuries up 2.4% on the lower rates. However, high yield basically flat. So even though rates have dropped a lot, high yield bonds didn't increase much at all because they're the risky end of the bond market. So market could be pricing in higher chance of credit losses in these high yielding sectors. Dollar holding flat 102. Spinning doji here. We do expect this to hold, and if the market goes more into risk off mode, we could see this bounce as some flight to safety towards dollar assets. With that, we can see euro flat and yen down a little bit too, with the dollar stronger. Then Bitcoin is off 1.75%. We've had a good run up and stalling here. And if you've been watching the channel, you've been seeing me say that Bitcoin and meme stocks have had a good run up this last week or two. Normally, they're not the best indicator. They're not really front running big major market moves. Normally, it's good to be on the other side of that, which I have been. Commodities off a lot. Commodities off a lot with that slower retail sales, and PPI down as well. So inflation at the wholesale level coming down as well. So that's not a good sign for economic activity. Dr. Copper had a huge gap up and then a big bearish move down on huge volume, and we're still 10.72% above the 50 bar here, so that it almost looks like a tradable mean reversion play short. Gold off a little bit, silver down, oil, a good economic indicator, was down almost 2%, natty gas down 8%. We're still playing that contrarian bounce here. We still think this could be a bottom. We are almost 40% below the 50 bar, so we are deeply oversold in natty gas here. And even though this might be a 50-50 play, the risk reward's 2 to 3 for what you have to risk to what you could potentially gain, even if we just get a 50% retracement of this move here. Uranium was off pretty good. Industrials down almost 2%. Transport's off 1%. Energy off 1.8%. Materials down 1.4%. Clean energy, the best performing sector today, held up almost flat. Gold down, real estate down, financials were down hard 1.8%. Retail was off 1.5%. Semis did okay, so did bots. And the defensive sectors, healthcare, consumer staples, and utilities off the most. BlackRock Barometer was down 0.3%. Mega cap tech did okay. Normally likes lower rates and wasn't too much affected by this retails report that came out. Meta was off 1.7%. Netflix was actually the only positive one out of the group, but basically flat. Tesla pulling back a bit by 2%. The meme stocks are off. If you've been watching, you've realized that I've been saying this is a contrarian indicator, and you want to be on the other side of these things. United reported today, and even though it came in well, the market kind of already expected that and kind of front ran that. You can see that in the move. So we gapped up, sold off hard, big bearish engulfing candle there. Other stocks that had a good bounce on the last few days have sold off hard today. Turn course. One that was really stood out today and is a long-term favorite of ours, we've actually got this in our equity long-short portfolio over on Collective 2, is Moderna. And that had some good vaccine trial data came in today, and we really like this long-term. Even on our stock fair value indicator, we've still got fair value at well above where we are now, and quality score is good, crash risk score is low. So this is definitely a stock, and something I like to do is when the market's off, you really want to pay attention to stocks that are up on days like this, because that's kind of the market telling you it likes this stock regardless of what's going on in the market. So it's kind of doing its own thing, and that's a way to get a different exposure in your portfolio, is when if you've got all stocks like this, growth stocks, then you're just leveraged to the market. You've just got a leveraged market portfolio. But when you've got some other stocks like this, that's what gives you the real diversification benefits. So we really like Moderna here, both technically on this big volume thrust and fundamentally and on valuation. I actually think it could be one of the biggest companies in the world by 2030 because of their cancer vaccines and other vaccines. Regardless of what you think about vaccines, their revenue and cash flows and product pipeline is undeniable. So that is definitely one to watch. Okay, so over to my final analysis on the SPY. That's why a lot of you come here for and to see. So we'll just flick on the trend candles. We can see we're bullish on the short term, bearish on the medium term, bearish on the long term weekly. Okay, so I went into I finished yesterday at 60% net short. Today I've actually increased that to my maximum 80% net short. I don't go above that. I never go above 100% net long or 80% net short. And I did make the long side of my portfolio more defensive as well. So we're still technically overbought in the short term and downtrend in the medium term. And with these moves in the market today, I'm happy to remain net short. It looks like we have rejected off this trend line, so we may not get a little peak above or bull trap above. We actually may resume the downtrend. So that's how I'm positioned. Of course, you've always got to remain nimble and adapt, and I'm willing to change if the market changes. However, with the fundamental overhang, I mean, Microsoft laying off 10,000 jobs, retail sales down, the market, the pricing in slower economic growth and higher chance of recession, and range strength at 12 here on the medium term, and all this just overhang and this fundamental and technical overhang, it's just hard to feel bullish. It just doesn't feel like bull mode to me. So I'm positioned bear mode, and I will continue that until I am proven wrong or we get a swing back down here. Then I'll start getting more neutral in my portfolio. Okay, that finishes it for today. Thanks very much for watching, and be sure to subscribe if you haven't already so you get these daily videos show up in your feed, and we hope to see you again tomorrow for tomorrow's price action. Okay, cheers.